Today we will be analyzing a recent report written by a critic of Palantir Technologies. By understanding both sides, investors can make a more informed decision about whether Palantir represents a strong investment opportunity or if its current valuation presents too much risk. Despite persistent doubts from certain analysts and financial commentators, shares of Palantir have continued to surge, proving many naysayers wrong. While concerns about its lofty valuation remain a key topic of discussion, the stock has defied expectations, consistently climbing higher. This steady upward movement in stock price raises an important question. Has Palantir finally reached its peak, or is there still significant room for growth? For many technology firms, maintaining rapid expansion becomes increasingly difficult over time as they must consistently surpass their own high sales numbers from previous years. This creates a challenging dynamic where growth rates naturally tend to decelerate. However, Palantir has managed to avoid this common pitfall. Instead of slowing down, the company's growth trajectory has accelerated. During 2023, Palantir exhibited signs of stagnation, with some investors beginning to question whether its impressive growth days were behind it. However, the introduction of its cutting-edge artificial intelligence platform has reshaped the company's trajectory. With a business model built around delivering data-driven insights and solutions, Palantir has managed to capitalize on the growing artificial intelligence revolution. This ability to innovate and adapt has fueled investor enthusiasm, further driving the stock's upward momentum. While Palantir's ability to generate excitement is undeniable, one of the primary concerns surrounding the stock is its extremely high valuation. Analysts who regularly assess stock performance frequently update their price targets to reflect new earnings reports, industry trends, and market conditions. Investors often rely on these projections to gauge how much potential upside a stock may still have. Following Palantir's latest financial report, many analysts raised their price targets, acknowledging the company's strong performance. Some even set ambitious targets exceeding $100 per share. However, the broader consensus remains more conservative, with the average price target standing at $69 per share, far below its recent trading price of $116. This discrepancy between analyst expectations and the stock's current valuation raises questions about the sustainability of Palantir's rally. With such an elevated price relative to traditional valuation metrics, it becomes increasingly difficult to make a compelling argument for continued upside unless investors are willing to overlook conventional financial reasoning. For several months, Palantir has demonstrated an ability to defy traditional valuation logic, maintaining an upward trajectory despite concerns about its premium pricing. However, stocks trading at excessively high multiples often become vulnerable to significant pullbacks, especially if broader market conditions shift. As a result, Palantir's current valuation places it in a precarious position. At one point, Palantir's total market capitalization exceeded that of Wells Fargo, one of the largest financial institutions in the United States. Additionally, the company's valuation has surpassed those of long-established blue-chip corporations, including McDonald's and Walt Disney. These comparisons highlight just how much investor enthusiasm has driven Palantir's stock price beyond traditional benchmarks. Before its recent rally, many investors already viewed Palantir as a speculative investment. Now, with the stock at even higher levels, that speculative nature has only intensified. As a company primarily focused on data analytics, Palantir has benefited immensely from the artificial intelligence boom in multiple ways. While Palantir has delivered strong financial results, investing in the company at its current price requires a willingness to ignore traditional valuation concerns. Investors must also be comfortable with the possibility of a slowdown in artificial intelligence spending in the future. Betting on Palantir at these levels means relying on the concept known as the greater fool theory, which assumes that someone else will be willing to pay an even higher price for the stock despite the apparent overvaluation. For investors considering buying Palantir, it is essential to weigh both the potential rewards and the risks. While the stock could continue rising, there is no guarantee that its current price or an even higher one will remain sustainable over the long term. Market trends can shift rapidly, and stocks with extreme valuations often face sharp corrections when investor sentiment changes. You should also know, over the past 12 months, shares have skyrocketed by 369%, and this upward momentum shows no signs of slowing down in the current year. Chief Executive Officer Alex Karp remains highly optimistic about the company's long-term trajectory. In his most recent letter to shareholders, he emphasized that Palantir is still in the very early stages of a transformation that will unfold over many years and even decades. Karp's statement reflects his belief that the company is only at the beginning of a long-term evolution rather than nearing its peak. The company's latest earnings report delivered impressive results, with quarterly revenue climbing by 36% year over year. Growth came from both the commercial and government sectors, demonstrating Palantir's ability ability to capitalize on demand from enterprises and public institutions alike. Despite these strong financial results, Karp urged against complacency, stressing the importance of maintaining a competitive edge and fully leveraging the company's unique position in the artificial intelligence and data analytics space. He acknowledged that while the numbers were encouraging, continued success would require further innovation, strategic execution, and the ability to stay ahead of competitors in an increasingly competitive market. While many investors have been celebrating Palantir's strong performance, not everyone is convinced that the stock's meteoric rise is justified. Investor Daniel Jones remains skeptical, particularly regarding the company's current valuation. Jones, who is recognized as a highly regarded stock analyst and ranks among the top 5% of experts on TipRanks, has openly questioned whether Palantir's stock price makes rational sense. To support his argument, Jones has analyzed multiple potential scenarios for Palantir's revenue expansion over the next several years. His projections range from a moderate 20% annual growth rate to an extremely bullish estimate of 40% per year through the year 2027. However, even under the most optimistic assumptions, he believes that Palantir's current stock price remains excessively high and difficult to justify. According to Jones, even if the company were to achieve an aggressive 40% annual revenue increase, a scenario that would far exceed the typical growth rate of most publicly traded firms, it would still not be enough to rationalize the stock's current valuation. He describes the share price as being detached from fundamental financial metrics, arguing that investors are paying a steep premium without sufficient justification. Jones goes on to say that while Palantir's business model and technological advancements are undeniably impressive, the stock itself has become alarmingly overvalued. He warns that even great companies can become bad investments if their share prices are inflated beyond reasonable levels. He draws a sharp distinction between a company's operational success and whether its stock is a wise investment at its current price. He explains that many investors mistakenly assume that because a company is performing well, its stock must also be a good buy. However, as he points out, investing is not just about picking great companies, it is about finding them at reasonable valuations. If a stock is overvalued, it can still decline significantly even if the company itself continues to thrive. Wall Street analysts, in general, appear to share a cautious outlook on Palantir stock. Among the analysts covering the company, only 2 have issued a buy rating, while 10 have assigned a hold rating, and 5 have recommended selling the stock. This distribution of ratings results in a consensus stance of neutral, indicating that analysts are divided on Palantir's future performance. Adding to the bearish sentiment, analysts have set a 12-month average price target of $88.60 for Palantir stock. This projection suggests a potential decline of 24.5% from current levels, reinforcing concerns that the stock may be trading at unsustainable highs. Despite these warnings, some investors remain bullish on Palantir, believing that the company's artificial intelligence-driven solutions will continue to disrupt industries and drive long-term growth. As AI technology becomes increasingly embedded in various sectors, Palantir's role as a leader in data analytics and predictive modeling could allow it to secure more government contracts, expand its reach in the private sector, and further strengthen its competitive advantage. However, the key question remains whether these growth opportunities are already fully priced into the stock. If the market has already factored in years of future growth, then there may be limited upside potential, and investors could face downside risk if the company fails to meet the exceptionally high expectations embedded in its current valuation. In summary, Palantir's latest earnings report demonstrated strong year-over-year revenue growth and continued momentum in both government and commercial segments. The company's leadership, particularly Chief Executive Officer Alex Karp, remains highly confident in its long-term prospects and believes that Palantir is still in the early stages of a transformational journey. However, concerns over valuation persist, with analysts like Daniel Jones warning that the stock has become dangerously overvalued, even under optimistic growth assumptions. Wall Street analysts, on the whole, remain cautious, with the majority assigning hold or sell ratings and projecting a potential decline in the stock's price over the next 12 months. Ultimately, while Palantir continues to be a dominant force in artificial intelligence and data analytics, investors must weigh the risks of buying into a stock that has already seen an enormous rally. The balance between strong business fundamentals and a reasonable stock valuation will be crucial in determining whether Palantir's share price can sustain its momentum or face a correction in the near future. For more stock news updates, remember to press the like button and subscribe. With that being said, I will see you in the next video.